Hey guys, in this video we'll be learning all there is to know about forward contracts involving exchange rates between two currencies. So in the previous video we looked at how to set the forward price of a forward contract. In the case where we are compounding discretely, the seller of the asset may have some income which should be deducted from the forward price. But the seller of the asset may also have some additional cost for which he should be compensated by adding this cost. Now we are assuming that the income, capital I, and the cost, capital C, are occurring at the maturity, and here we are compounding once. If we are continuously compounding, then we have an income rate and a cost rate. And continuous compounding is interesting for assets that are very volatile, that are traded very often. For example, when we are dealing with exchange rate. In the case of exchange rates, the spot price SF/D is the price of one unit of currency in the domestic currency. So for example, if we look at euro over US dollar, then this ratio would give us the price of $1 in terms of euros. So when we consider SFD as our price, then this means that the buyer in this scenario holds foreign currency and the seller holds domestic currency. When entering the contract, the buyer is agreeing to buy the domestic currency from the seller for the foreign currency that he's holding. Now the buyer may hold on to the foreign currency for the duration of the contract, and in this case, the value of this money, compounding continuously, will grow by e to the power RF times t, where RF is the risk-free rate in the foreign currency. That means that this R right here is the foreign currency risk-free rate. But in the meantime, the seller is holding on to the domestic currency. This means that the seller can invest domestic currency at a risk-free rate RD. And we can view this rate as an income. The rate of income that the seller can earn with this money is I RD. So for forward contracts in exchange rates, the forward price will be the current spot price of the foreign currency over the domestic currency times, we are continuously compounding here, times e to the power RF minus RD times t. And one way to look at this is if you realize that this differential right here, if that goes up, that means that RF becomes relatively more attractive, which is advantageous for the buyer. Conversely, the seller will be at a disadvantage and he should be compensated for this by a higher forward price. So if this differential right here increases, then the forward price also increases. And that's what we also see in this equation. So with the formulas that we have, including income and cost, it's really easy to see what the forward price should be for exchange rates when you realize that the rate R is the foreign rate, since the buyer is holding the foreign currency, and the income rate is for the seller who is holding the domestic currency. So far, so good.